Good morning, everybody. I hope you've been having a great day at all these amazing sessions we are having at the 2020 Cal-ISBOA HR workshop. And just so you know where you're at, this is the session called Building Financial Intelligence for Today's HR Leader. And I'm going to hand it off to Donna, and she's going to introduce our amazing presenter. But before I do that, I just want to give a couple of housekeeping tips. We have everybody muted in this session. And in the last 15 minutes, we are going to open up a Q&A. So as the session's going on, if you have questions, please feel free to enter them into the chat. And we will read your questions at the end. If you can include the name of your school as well, that will help everybody. And I'll pass it off to Donna. Thank you. And Donna, I think you're unmuted. Yes, great, thanks.
Great. All right, well, welcome everyone. And I would like to take this opportunity to welcome Paul Butler. Paul is a client, my screen went away. Hold on a second. Pardon me, I had it up. Okay. Paul is a client partner at New Leaf Training and Development based here in Southern California in Valencia. And since 2005, the company has served over 240 clients in 28 states, China, India, Western Europe, and Australia. In 2016, his company opened a second office in Orlando, Florida. Paul is a chartered global management accountant, having qualified with PricewaterhouseCoopers in London, UK. He served as a regional finance director for Hilton and Marriott hotels in Europe. Prior to starting New Leaf Training and Development, Paul was the director of financial and marketing services for Hilton Honors, the world's largest loyalty program, when Hilton's worldwide headquarters was based in Beverly Hills. On a personal note, Paul lives in Valencia and has been married for 25 years this past August. He and his wife have 2 children who have just graduated from local universities, Brody from Azusa Pacific University and Henry from Chapman University. Originally from England, which you will pick up on here in a few minutes, Paul and his family will become American citizens this year. So congratulations, Paul, that's really exciting. Please join me in welcoming Paul as he facilitates our conversation now on the subject of business financial intelligence for today's HR professionals. Thank you.
Thanks, Michelle. Thanks, Donna. And I'm delighted to be with you today. I was just saying to Michelle and Donna, I mean, we're living the dream, aren't we, really? I mean, it's Sunday, we're in California, and we're studying business financial intelligence. I mean, can things get any better at all, you know? Well, if I can make you 3 quick promises for our time together today. You know, Donna, I can't think of any time in history when anyone that's originally from England has ever lied to an American. I mean, that whole 1776 thing was just a mild misunderstanding. But promise number 1, you'll not be bored. We're going to go at a quick pace. Promise number 2, this is going to be participative as much as we can be on these platforms in a short period of time. And then my 3rd promise is this is going to be very practical. I'm really a simple guy from simple Middle England that likes simple ways of looking at complex issues. I'm also cognizant from the pre-consults that I did with Donna and Michelle and Martha and Andrea that there's a whole range of skills on the webinar. And obviously, I've never done your job personally. So I'm hoping this is going to be a valuable session for you. I'm hoping it won't be too low for you. And I'm also hoping, obviously, it won't be too high for you. There's a great quote here from a gentleman called Patrick Lencioni, which I'm sure you've all heard of. He wrote a great little book called The 5 Dysfunctions of a Team. Obviously, we're not speaking about teamwork today, but I do like this quote. And he says here, that it's really, success is not really a matter of mastering subtle, sophisticated theory, but rather of embracing common sense with uncommon levels of persistence and determination. And I really like that turn of phrase. I love the simplicity of how he expresses that. And that's obviously what we're trying to achieve today. I've noticed that people that have a good financial acumen, they really can speak very, very clearly. So hopefully I can help continue that theme today. I think one of the reasons why we've been blessed with so much success as a training and development business is because we really teach principles. And principles, of course, are those things that are universal, they're objective, they exist with or without our permission, they're external to us. And you might be thinking, well, what on earth does that have to do with business financial intelligence? Well, the principle that's underneath this program, almost like a kind of a North Compass, is can you imagine a business? Can you imagine an organization where everyone working in the business, in the organization, is working as if they own the business? I mean, imagine what that would do to income and management of expenses, to assets and liabilities. And that's really the principle where we're trying to encourage employees to think like entrepreneurs. And we're also trying to encourage employees to contribute to the business as if they own the business. A lot of people say to me, well, what do you mean by business financial intelligence? And I've really distilled it down into, it's really a mindset and a skill set. It's all about application that few employees have and all organizations need. It doesn't matter whether you're a for-profit entity, a not-for-profit entity, government entity, or obviously a mission-based organizations. Every organization, of course, needs to make sure that its income is bigger than its expenses and its assets are larger than its liabilities, rather like how we have to personally. I've found that if we can relate personal finance to business finance or organizational finance, ka-ching, 9 times out of 10 you get the right answer. So what are we trying to achieve in the short period of time that we've got together today? So where are we going? What are our objectives? Well, here's a little visual which hopefully you can all see that's going to help navigate through our time together. So we're going to go from the top left, looking at the sources of cash for all organizations, and then we're going to go down the left-hand side, jump over to the right-hand side for some jargon busting, finishing up with some stuff about stock price, which I know obviously that as educational entities, you're not publicly traded, but some of you in your careers may go to work for publicly traded companies. So for the sake of like 60 seconds, let's look at the benefits of having a high stock price, because that's part of our financial acumen, of course. And then right in the middle is how we'll finish, is about the currency between people is trust, because it's people that hold all of this together. So let's have a look first of all then at the sources of cash. Have you ever stopped to think about it? There really are 3 sources of cash within every organization. We've got the operating cash. So that of course is we generate income because of what we do. And then we have expenses because of what we do. That's our operating activities. In Hilton Hotels, for example, we do what we do, or we did what we did when I worked with them, and we generate income because of that, but we also have a whole bunch of expenses. That's rather like your educational entity, isn't it? You have operating cash flow coming in from what you sell, and you have operating expenses going out because of what you do. That's the operating cash flow. And we want to make sure, of course, that our inflow of cash is larger than the outflow of cash. Have you ever stopped to think about it, that organizations, rather like individuals, also have an option to invest in things that have got nothing at all to do with the core operating activity? So your school, Hilton Hotels, Starbucks, a private company, even an individual can choose to invest in things that have got nothing to do with what they do. Obviously, when we invest in things, there's an outflow of cash. And when we sell those investments, there's an inflow of cash. And of course, an outflow of cash because of investing activities is not necessarily a bad thing, is it? Because you might be buying something that you can sell at some point for a higher price down the road. And then the final part of this, of course, is the financing activities. Now, obviously, for publicly traded companies, if they're selling their stock, they have an inflow of cash when they sell their own treasury stock. They have an outflow of cash when they buy back that stock. They have an inflow of cash if they borrow money, which is what we call debt financing, of course. And there's an outflow of cash when we pay down that debt. Even private entities, of course, have shareholders, but they're just not publicly traded. So notice on all 3 of these that cash flows both ways. If you've ever looked at the statement of cash flows, this is the structure of the statement of cash flows. Operating activities at the top, investing activities in the middle, and financing activities at the bottom. One of the wonderful things about finance, and I did say the word wonderful and finance in the same sentence, is that the only things that change really are the accents and the spelling. That because of generally accepted accounting principles, it doesn't matter where you are in the world, this is the structure essentially of the statement of cash flows. Do you remember our second one down the left-hand side was working capital, sometimes called operating capital. So depending on the type of organization you worked for in the past, or how you structure things internally in your present role, or where you may go into the future, some organizations call this working capital or the operating cycle or operating capital. I don't know if you've ever thought about it before, but there actually are 6 elements of working capital, but not all organizations have all 6. So we've got cash, which of course is an asset, accounts payable, which is a liability. Now, for a manufacturing business, we'll have raw materials. If for a manufacturing business, we'll have work in progress, sometimes just called WIP. And then as a manufacturing business, we convert that work in progress into inventory. Notice, Donna, I said inventory, not inventory. I'm hoping that one comes up on our citizenship test this year. A few baseball questions and I'll be in. Now, a retailer, of course, has inventory. It doesn't have work in progress or raw materials. It buys its inventory from a manufacturer. And then obviously we've got accounts receivable. So raw materials, work in progress, inventory are all assets as well as cash because we own those. Now, essentially, you can boil that down to these 4: cash, accounts payable, inventory, and accounts receivable. Rhetorically, what's the difference between inventory and supplies? Well, supplies are what we own that we're going to use, for example, Post-it notes, but inventory is what we own that we're going to sell. Now, on the pre-consult that I did for today, obviously I understand that the vast majority of you wouldn't have any inventory, unless you're talking, for example, about maybe the bookstore, where you own inventory, which you're then going to sell. You know, I think it'd be rather interesting here is why don't we play the working capital high-low game? So if I may, I'm going to open up our first poll. So the question here is, do you want your cash to be as high as possible or as low as possible? So you've got 3 choices: as high as possible, as low as possible, or as high as possible within reason. Might be a trick question right there. Let's see if we can get 100% participation. This is much more interesting than your email. On your mark, get set, go. Oh my gosh, knock me down with a feather. We've already got 100% participation. I'm going to share the results with you. Could I get a virtual high five? Boom, boom, boom. Yeah, really, the answer I would tend to go for here is that third answer, which I can see that 77% of you went for, which is as high as possible within reason. Because wouldn't you agree with me that that cash that we've got on the balance sheet is going to be earning us about 0% interest? So we need enough cash to be able to meet our expenses, like how we can relate to that personally. But if we've got excess cash, we want to sweep that cash off and get that cash working for us. I know that Michelle wouldn't mind me telling you this, but Michelle said to me just before we opened up the waiting room, she's got $412,000 in cash and cash equivalents, you know, the things that she can convert into cash in less than 90 days. So she's thinking about moving some of that. So Michelle and I have just become friends on Facebook. We're going to have some fun. We're on a webinar. So we want our cash to be as high as possible, but within reason, of course. Next one, you ready? Inventory. Now, I'm sure we can all relate to inventory. Here's the question then, second poll. Ready? Do you want your inventory to be as high as possible, as low as possible, or as low as possible within reason? They're a sharp bunch, Don. I think we'll be finishing early. We've got 82% of you have voted. We've got 87 people on the Zoom. I'll give it just another 15 seconds. If you're not quite sure, take a guess. No one's tracking IP addresses. Going, oh, nearly at 90%. Going, gone. So I'll share the results with you. Yeah, again, I'm delighted to see that the vast majority of you got the correct answer here, as low as possible within reason. And of course, the disadvantage of having too much inventory is you're going to be tying up unnecessary cash, aren't you? So we want to have enough inventory to be able to meet the demand. But if we're not careful, we're going to be tying up too much cash. Hey, have you guys heard of Walmart? It's like a small boutique store that's just starting out. It's kind of a mom and pop business. I'm just having fun. But I've got a very good friend. Donna's like, no, you don't. No, I do, honestly. I have a very good friend. I pay them on a monthly retainer to be my friend. But he's one of those general managers at one of those big super Walmarts. Now, he said, don't tell anybody. But they're a publicly traded company, so I can share this with you. He said, one of our management goals is to sell 80% of what's on our shelves before we even pay for it. Did you hear that? To sell about 80% of what's on their shelves before they even pay for it. They're in a very, very low profit margin business, but incredibly high volume. When you and I walk into Walmart, we pay by cash or something that's the equivalent of cash, like a debit card or a credit card. They get that cash immediately, and they take on average about 90 to 100 days to pay their vendors. That's their business financial intelligence model. Low margins, incredibly high volume. Talking of volume, anybody know what they did last year in sales? $750 billion. Did you catch that? $750 billion. Anybody know what their net profit margin percentage was last year? Just under 3%. I don't know about you, but I wouldn't mind 3% of $750 billion. By the way, they actually invest in a whole bunch of things that have got nothing to do with their operating activities. Why? Because their objective is to maximize shareholder wealth. It's not world peace. It's to maximize shareholder wealth. They know that they can only get this amount of margin percent, but it's an incredibly high volume number. And they choose to invest in things that have got nothing at all to do with Walmart. Now, here's the next one, 3 of 4. So we just kind of on the home stretch, as it were. What about accounts receivable? Do you want your accounts receivable to be as high as possible? In other words, take as long as you want to pay me. Or do you want your accounts receivable to be as low as possible? I want to get that as quickly as possible, but as low as possible within reason. By the way, these are great games to play on a Saturday night with the family. You could play the working capital high-low game. I can send you the slides if you want. It really kind of brings the family together. We're going to have some fun. We're on a webinar. Just over 80%. Let's see if we can get 100%. You might want to cover up your work. Make sure no one's copying. Beautiful. Yeah, so again, you guys are a sharp bunch. Yeah, as low as possible within reason, I would tend to agree with, because you want your accounts receivable, you want to be collecting your accounts receivable as quickly as possible. But can you imagine, for example, let's say if Michelle was my boss and Michelle's, say, the area director for sales, and I'm a direct report to her, and I say to her, hey, Michelle, great news, my accounts receivable is really low. In other words, and she's like, well, it's because you haven't sold anything. So we want to collect our receivables as quickly as possible, but obviously we want to be getting the volume of the sales as well. So here's the last one then, accounts payable. Of course, accounts payable is the opposite of accounts receivable. I'll bring that up on the poll for us as well. Do you want your accounts payable to be as high or as low as possible? So as high as possible, or as high as possible within reason, or as low as possible. Another way of asking this question is, how old do you want your accounts payable to be? Pay people as quickly as possible, or stretch it to the terms that you've agreed? but not go over the terms. I feel like I'm leading the witness. Again, thanks for your participation here. It can get very boring if someone's just speaking at you for 45 minutes. Love to get your participation here. The wisdom's really on the webinar. I'm just organizing this into common sense. I've just found that common sense is not that commonly practiced. So we're at nearly 90% again. Going, gone. Again, I'm delighted to see that the vast majority of you got what I would agree with, which is as high as possible within reason. So for example, if you've agreed like 45 days to pay your vendor, you really want to be paying them on day 45. You only want to be paying them earlier if you're sitting on a whole bunch of cash and you can get an early payment discount. Obviously, the danger of going over the terms is the vendor probably has something written into the contract where they can charge you interest on the late payments of debt. So you want your accounts payable to be as old as agreed, as it were, within the term. So you want it to be as high as possible. If I may, just a very, very quick example here. Hilton Hotels, when I was a regional finance director for them over in Europe, we'd agreed 60 days with our major vendors for things like, for example, our bread, our meat, our laundry supplies, and for our beverages. And this one particular hotel in London, where the controller reported to me, I noticed that his accounts payable was really low and his cash was really low. And in fact, he had to borrow money on occasion on a short-term line of credit that we got for that hotel. And when I actually did an audit with him and sat down with him, he basically said to me, well, I have Mary come in every Friday and she pays the vendors every Friday. She's only on minimum wage, Paul, but she just stays on top of that. And that's really why my accounts payable is so low, even though we'd agreed 60 days terms with these vendors. And as Albert Einstein said, that's the trouble with most accountants. They know the cost of everything, but the value of very little. There's really a difference between being a good bookkeeper and having good business financial intelligence. Sounds to me like you guys understand this. Down to the bottom left-hand corner, margin, of course, is sometimes referred to as profit. So rhetorically, I'll put the chat function in here, but we're not going to answer this as a chat function. Rhetorically, I'm asking the question here, what is gross income? Sometimes, of course, gross income is referred to as gross profit or gross margin. Guess what? It all means the same as long as the G word is at the front. Some manufacturing businesses or retail businesses or service-based businesses might kind of switch it up between gross income, gross margin, gross profit, but it all means the same as long as you've got the word gross at the front. Well, here's a rather simple example. Give me a second. Sorry, guys, I've got this ridiculous thing where the lights go off in the office if nobody moves for about half an hour or so. Think about Starbucks. When you and I buy our favorite beverage in Starbucks, let's say you pay $5 for that. And let's just say, for sake of argument, the cost of goods sold is $1. What's the cost of goods sold? Well, you can feel it in your hand. It's the cup, the lid, the stirrer, obviously the beverage inside the cup, the sugar, etc. That really is the cost of goods sold. Let's say that cost $1. Well, if you paid $5 for it, and the cost of goods sold is $1, you'll never guess what the gross income, the gross profit, the gross margin is. It's $4. But you could also express that as a percent, couldn't you? So like 80%. Now, fingers on the buzzers, 2 weeks vacation in Cancun, all expenses paid by Donna because she's absolutely minted. What was cost of goods sold a few seconds before it was sold? Inventory. It was owned by Starbucks, but they used it to fulfill the order, and so it turns into an expense. So cost of goods sold is simply an expense that a few seconds ago was inventory. If you like, it's come off the balance sheet and it's turned into an expense. We compare that against the income to give us the gross profit, the gross income, the gross margin. If we come a little bit further down the hopper, as it were, a little bit further down the income statement, also known as the profit and loss account or the statement of operations, we then get down to what we call operational income or operational margin or operational profit. It all means the same as long as which word's at the front, operational. So what is that? Well, this is where we're going to deduct things like the labour, because that labour is not cost of goods sold. I mean, the barista is not inside your beverage. And so we're going to deduct, for example, the cost of labour. We're going to deduct insurance expense, Wi-Fi expense, the depreciation on the furniture and fittings, any sales and marketing expenses for that individual store, the rent at that individual store. That's going to bring us down to operational income. There's some other images on the screen to depict what really are operational expenses. Remember, things like the coffee machine and the tables and chairs and the refrigeration, they're really assets, aren't they, on the balance sheet? But it's their depreciation that becomes the depreciation expense that's really an operating expense. It gets us down to operational income, operational profit, operational margin. So nearly done. We're now nearly towards the bottom of the income statement. Forgive me if I'm stating the obvious to you. I'm hoping this is valuable for you. We get net income or net profit or net margin right at the very bottom. Well, let's change hats. Let's imagine that every single one of us on this webinar is a general manager at a Starbucks store. We're going to take our bag of operational income and we're going to take it up to the corporate headquarters up at Seattle, Washington. What are some of the expenses that you can see, hear and feel inside the headquarters that get deducted from our operational incomes to bring us down to net income? Well, what do you see in there? Well, there's going to be rent or a mortgage on that property, insurance. There's going to be things like, for example, Wi-Fi, all of the central support functions like human resources, finance, legal, research and development, depreciation and amortization at the headquarters. We'll talk about amortization in a few minutes. Dividends, if the company pays dividends. We may have, for example, interest, if we're paying interest on any debt. That's going to get us down to the proverbial bottom line, which is going to be net income. So right where we need to be time-wise, let's go up to the top right-hand side now. When I did the pre-consult with some of your colleagues, I thought, well, let's just make sure we understand some of the commonly heard, commonly misunderstood jargon. So here's the first one I thought we could have a look at. And it would be the word accrual. I love that mug there, Donna. It's a cruel world. Commonly heard, commonly misunderstood. Here's another one, depreciation. The amount of times I've heard people misexplain depreciation. Another one would be EBITDA. Now, I'm very conscious that within a private education entity, you might not use the phrase. In fact, I'm confident you don't use the phrase EBITDA, but you do things that are far more complicated than this. In the past, you may have worked for an organization where you used that phrase but didn't quite understand it. Who knows? You may start to bring in EBITDA into your private educational entity because it really is a key business measure. And who knows where your career is going to go for the future. So for the sake of a minute or two, it might be worthwhile having a look at that one. And then the last one being weighted average cost of capital, especially those of you on the webinar that have the responsibility to sign off on major capital investment projects. I've found people don't understand, for example, the weighted average cost of capital. And if I could be quite bold, I find that most accountants can't explain it. And hopefully I can explain that for us a little bit simpler. So metaphorically asking this question, you know, what is the accrual concept? Well, wouldn't you agree with me? There's really two bases of accounting. There's the cash basis of accounting, which is when we record the transaction when the cash actually changes hands. But the accrual basis of accounting records a transaction regardless of whether the cash has changed hands. So for example, if somebody pays us a deposit, we're going to record the transaction because our cash is going to go up, but we have a liability on the balance sheet because we owe someone that product or that service. If we prepay, for example, our insurance, we own the right to that insurance. So we've got an asset called prepaid expenses. and our cash has gone down because we've prepaid, for example, our insurance. We then record the using up of that insurance as each month passes. That's another example of the accrual basis. Another one would be accrued revenue. Take the A, take the R, put them together. Isn't that accounts receivable? That's where you've provided the product or the service, but you're not yet being paid for it. So you can record the income because you've earned it, but you've got the asset on the balance sheet. When obviously that person pays you, accounts receivable goes down and your cash goes up. Fourth and final one would be accrued expenses. That's where you've purchased something, like let's say, for example, inventory. So you've got the asset on the balance sheet, but you've got the liability of accounts payable, or maybe a notes payable, which is a longer term liability. Now, obviously, when you pay that payable, the liability is going to go down or away, and your cash is going to go down. I've found that most accountants can't explain the accrual basis of accounting, but you really have a duty to be able to explain this to your operational managers, especially if you're trying to encourage them to take accountability for the financial statements that you share with them. By taking a few minutes and explaining the accrual basis of accounting can really clarify a lot for non-financial managers. What is depreciation? Well, depreciation, of course, it's a great example of the accrual basis of accounting. Which of those four does it fall into? Is it unearned revenue? Is it accrued revenue? Is it accrued expenses? Or is it prepaid expenses? It's actually prepaid expenses, because prepaid expenses are simply assets that turn into an expense when they've been used. So if you purchase something like maybe a LCD projector and you pay $3,000 for it and you're going to use it for say 3 years, well, your cash goes down when you pay out $3,000, but you've got an asset on the balance sheet that you own that's worth $3,000. And as you use up that LCD projector, we need to record the using up of that asset. So the asset goes down after say 1 year by $1,000, and we have depreciation expense on the income statement. Hey, you'll never guess what happens on year 2. Exactly the same if we're talking straight line depreciation. The asset goes down by another $1,000, and then the depreciation expense goes up by $1,000 because the cash went out like 3 years ago. Depreciation is really recording the using up of an asset. Now, what about EBITDA? It's got nothing to do with Star Wars. Some of you might be thinking, I'm sure that's to do with Star Wars. Well, what is EBITDA, and why is it such a useful non-GAAP measure? So the E stands for what? Earnings. What does earnings stand for? Net income. Did you catch that? Net income is also known as net profit, net margin, but it also can be referred to as earnings. It's also, by the way, the word return. So when we talk about like return on assets, we're really talking about net income, net profit, net margin, earnings. When we talk about return on equity or return on invested capital, the R, the return, is the E of EBITDA. It's also the net income, the net profit, the net margin. What's the B? Before. What's the I? Interest. You know, those people that you pay those debt investors, the monies you pay those debt investors. What's the T? Tax. What's the D? Depreciation. What's the A? Amortization. Sidebar comment. What's the difference between amortization and depreciation? Well, whereas depreciation is the reduction in value of a tangible asset, you know, something you can touch and feel, amortization is the using up of an intangible asset. Some of you may have some amortization on your balance sheet. Amortization is usually things like patents, royalties, trademarks, copyrights, and goodwill, which is where like organization number 1 has purchased organization number 2, and the price they paid was larger than the net asset value. And so that delta, that difference, is what we call goodwill, which is amortized if we're not keeping it in a good state of repair. It's a useful non-GAAP measure. Why? Because it really gets to the pulse, the heartbeat. It's really the operational performance of the organization. So EBITDA is a really, really powerful measure. Why? Because it strips out, did you catch that? It really strips out all of the noise of interest, tax, depreciation, and amortization. It really gets to the heartbeat of how well the organization is performing. Last one on here is WACC. What does WACC stand for? Well, WACC stands for do you remember that one? Weighted average cost of capital. It's really looking at the fact that all organisations, whether they're corporate, educational, private or public, government entities, mission-based organisations that don't pay tax because of their social purpose, it's basically saying that all organisations have two sources of funding. They have debt capital and equity capital. I like to call them Mr. and Mrs. D and Mr. and Mrs. E. Can you see how I got that? D for debt and E for equity. Well, the reward that the debt investors get is interest. So that comes at a cost, obviously. And there are different types of debt. There's short-term debt, long-term debt. There's some debt that can be converted into equity. There's debt, of course, that has a lower interest rate because of that. There's some debt that's attached to your buildings, like mortgage debt, which is one of the cheapest forms of debt. And if you don't pay it, they take the building off you or take the vehicle off you. Now, on the other side of the coin, we've got equity. And of course, the reward for the equity investors is they're looking for share price growth. I'm not doing a dab, by the way. It's share price growth. Or they're looking for dividends. And of course, not all organizations pay dividends. So there's a cost of working with the Ds and there's a cost of working with the Es. And all the weighted average cost of capital does, it takes the proportion of your debt capital, multiplies that by the average cost. It takes the proportion of your equity capital and multiplies that by its average cost and puts the two together. Let's just say, for example, that says 10%. Guess what that's telling us as operators? We've got to make sure that any capital investment project has returns, net income, earnings that are greater than 10%. Because if not, we're destroying shareholder value. If not, we'd have better off been putting the money in the bank. And that really is what the weighted average cost of capital is. I love the way that it's sometimes referred to as a hurdle rate because we have to get over that hurdle. If we don't get over that hurdle, we're destroying shareholder value if you're in a for-profit entity. And obviously, if we do get over that hurdle, we're creating shareholder value. You may have heard a fancy phrase if you follow any business podcasts. Sometimes that's called economic value added. That's where the net income is bigger than the weighted average cost of capital. Or you'll hear it referred to as negative economic value added or negative EVA. And that's where the actual returns from the project are less than the cost of capital. I hope I'm honouring those three promises for you, that you wouldn't be bored and it would be practical and somewhat participative. I think for the sake of a few minutes, why don't we just make sure in a safe learning environment, we're all absolutely solid on the income statement, sometimes referred to as the profit and loss account or the statement of operations, and the balance sheet. Let's make sure we're really clear on what these are. Now, the income statement is really about three things. It's income minus our expenses gives us a profit or a loss. The balance sheet really goes across the middle. So kind of BC, not being blasphemous, but before computers, this is how they used to draw up these two financial statements. The profit and loss account down the center and then the balance sheet across the middle. So assets minus our liabilities must be equal to our equities. Let's translate that a little bit further. Wouldn't you agree with me? Income is what we've earned, even if we've not yet received the cash according to the accrual basis of accounting. Expenses are what we've used or what we've spent, even if we've not yet paid out the cash. And the delta, the difference between what we've earned and what we've used, is what we've made. And we've either made a profit or we've made a loss. Now, assets are what we own. Liabilities are what we owe other people. And equity is really what we owe the owners because they own the organization. If it's a proprietorship, we just call it owner's equity. If it's a limited liability company, we'll call it members' equity. If it's a partnership, you'll never guess what, we call it partners' equity. And if it's a corporation, we'll tend to call it shareholders' equity or shareholders' equity. But the word that doesn't change is equity. Bottom right-hand corner, benefits of the high stock price. Hey guys, please don't switch off because I don't know what you were doing before the role you're in now. And I don't know where you might be going within your role. About 40% of our clients are educational entities, and on those private educational entities, some of those actually have a nominal or a notional stock price, because there is actually a stock that changes hand, but it's really between private investors. Be inappropriate for me to name those organizations, of course. But for the sake of like 60 seconds, because I don't know where your career is going to go, why don't we look at the benefits of a high stock price? You know what I've noticed? Hey, lean in. I've noticed that if you ask most corporate employees, you know, when they're running around the corridors saying, hey, great news on the stock price. Great news on did you see the stock? Great news on the stock price. If you actually stopped them and said, could you give me the 6 benefits of a high stock price? They'd probably say, oh, I was actually going to get another donut, you know. So let's make sure on our watch that we all understand the benefits of a high stock price. Well, the first thing is that the treasury stock is worth more. Do you remember the stock or the shares, they're interchangeable terms, that a company owns of its own? We call that treasury stock. It's almost like you've got tins of baked beans with no expiration date. And when people want your baked beans, guess who's got the baked beans? We've got the baked beans. So when you put that treasury stock into the market, guess what? It's worth more because the stock price has gone up. Secondary offerings bring more cash. When a company first becomes a publicly traded company, what do we call it? We've all heard it, IPO, initial public offering. But the second and subsequent offerings, we don't call it like the 412th offering. The second and subsequent offerings actually bring more cash. Why? Because the stock price is higher than what we purchased it for. Catch this, number 3, we can actually buy debt cheaper. Why? Well, I'm no psychologist, I'm a recovering accountant, but when there's a lot of when there's a high stock price in a business, the implication is that you're obviously doing well. And so you can normally attract debt investors cheaper because they know that you're good for it. They know that they're going to get paid. And guess what? You can actually buy convertible debt. That's debt that has the option to convert into equity. Why would someone want that? Well, if the stock market's going up, a D would rather be an E. If the stock market's going down, an E would rather be a D. So you can actually buy convertible debt cheaper because you've got an exciting stock price. Number 4, you've got more acquisition power. You guys follow the news. You guys listen to podcasts. You guys have got a sharp business acumen. What are most acquisitions done by between company A and company B? A combination between stock and cash. You want to hold on to your cash, of course. And so if you've got a high stock price, you can kind of gobble up, a bit like Pac-Man, you can kind of gobble up someone that you want to buy by giving up less of your stock if you've got a relatively high stock price. We've already spoke about number 5, you can attract convertible debt, which is cheaper. And you can also attract and retain talented employees. Have you noticed that? I mean, I've noticed that talented employees want to be associated with winning organizations. Obviously, I'm sure all of us have been party to, for example, share options in the past or in the present. And that is a way of attracting and retaining talented employees. And then finally, you become more expensive in a buyout. Why? Well, let me get my head around this. Isn't that like number 4 in reverse? Because if you're a big fat Pac-Man, someone's got to give up a lot of their cash or a lot of their stock, which is where they're risking giving up control to get kind of a nibble at your knees. And so it really is a good defense mechanism when you've got a high stock price. And then finally, and dare I say, most importantly, it's people that bring all of this together. And that really the currency between people is trust. What we've noticed doing what we do in this particular area of work is that if you share financial information with employees, they tend to trust you more. And if you can encourage people to think like entrepreneurs, what we call intrapreneurs, where you're really tapping into that entrepreneurial mindset, I mean, ka-ching. See what that does to your income and your expenses and your assets and your liabilities. Now, this is a great book. I'm sure you've probably read it or you've heard of it. It's about 384 pages, I think. But really, Stephen M. R. Covey boils this down into one simple principle. He says, look, let's look at the yellow line first. So let's look at the bottom line first of all. Let's be on the positive side. He says that when trust is high between people, in other words, you're sharing financial information, you're investing in their financial education. When the trust between people is high, then the speed of doing business goes up. People make faster, quicker, smarter decisions. There's less bureaucracy, less red tape, less double checking. There's less gossip in the workplace. Therefore, the cost of doing business, tangibly or intangibly, goes down. And if we just dwell on the negative, the grey row for a moment, wouldn't you agree with me when trust is low within an organization? I mean, think about someone you work with where the trust between you is low. If they're on the webinar, feel free to point at them. I'm just having fun. Spotlight their video. But if you're working with someone where the trust is low, have you noticed how everything slows down? There's more meetings about meetings, bureaucracy, red tape, gossip. You remember the water cooler back in the day and the coffee pot back in the day when we actually used to go to buildings? Well, have you noticed that everything slows down because the trust is so low? Therefore, the cost of doing business, tangibly or intangibly, goes up. The point I'm making here, of course, bottom line, is all this is fine and dandy, business financial intelligence. But if the culture of the organization is low trust, I mean, you're wasting your time really investing in this because people won't trust you. You've got to share information, educate people on what it understands, and continually work on building the trust within the people. So that really is our little model that we've put together. Won't verbalize it all again, but hopefully that was a useful summary for you. Closing couple of comments before we open up for any Q&A would be that the principle underneath is, like we said earlier on, is that can you imagine an organization where everyone working in the organization is working as if they own the organization? If you can get their perceptions to align with that principle, the window through which you see the world, you'll see what will happen to their behaviors. Behaviors, of course, are what we say, what we don't say, what we do, what we don't do. Hey, notice, Michelle, I've took out the unnecessary vowel there on behavior. I'm hoping that one comes up on the citizenship as well. But those behaviors, of course, will then impact your results. We've definitely noticed a correlation between investing in the financial acumen of your employees and the results of that organization. It's kind of unquestionable, really. A couple of resources I'd recommend for you to consider. On the left-hand side, some of you may have heard of Ram Charan. He wrote an excellent little book called What the CEO Wants You to Know. On the far right-hand side, another great little book. It's really more tagged at the kind of management level by the late Karen Berman. Unfortunately, Karen passed away a few years ago, and Joe Knight, called Financial Intelligence. And then, look at that. How self-serving is that, Donna? Oh. Our goal is by, what date have we got? August the 7th. This should be available on Amazon and obviously on our website. And you can see there, business, financial intelligence and mindset, and a skill set few people have and all organizations need. So that was me. There's my email address there if I can be of any help to anybody. And with that, Donna, I'm going to stop sharing my slides. And we'll go back to the Zoom. And I really hope that was useful for you guys. And I was tempted to put like closed captions up on the screen when I was speaking, but Donna says, no, you're kind of understandable. Just like flatten the vowels as much as possible. So I can see some questions in the chat function. Michelle, do you want me to address those or do you want to call them?
Yes, you can go ahead and read any questions that you might see.
All right. I've noticed I've started wearing my glasses over Zoom over the last couple of months. My wife bought me these for Christmas and I was reluctant to wear them. And she said to me, you need to wear them. I was like, oh gosh, I feel like I'm getting old. She says, well, these ones look good. You look like Richard Gere. Is that true? What do you think? Like if I was on like a really fast horse or something. Let's have a look at this. What is the best way to explain reserves to faculty and the community and dispel that we aren't trying to hoard money? Can I ask for some clarity there, Margaret? Are you talking about reserves in the context of making accruals for likely expenses in the future? If you could just maybe add to that one while I... Barbara says, yeah, the glasses do make you look like Richard. What about from the back? What about from the back? More so? Good stuff. Yeah, I can't see any other Oh, cash reserves for facilities a rainy day. Yes, so forgive me for stating the obvious there, Margaret, and I'm sure for some of the other participants on the line, you have to be really careful there from a generally accepted a generally accepted accounting principles perspective, because you should really only be recording an expense, obviously, when you've actually incurred an expense and then creating that liability on the balance sheet. And so if you're creating cash reserves for facilities for a rainy day, that would suggest to me that you're creating an asset on the balance sheet for an expense that you haven't really had. In terms of how I would explain that to faculty, I'd probably come at it more from the angle of, that, in September, this is going to happen, in December, this is going to happen. And so I need to be making sure we've got enough cash reserves to be able to cover that expense when that does happen. Hopefully that's answered your question there, Margaret. I'm going to put my email address in here as well, in case anybody has any other questions, or if Margaret's like, no, dude, you didn't answer my question. And I'll be happy to have a chat with you about that. Notice I used the word dude there, Donna. I never used the word dude until I moved to California. I'm like completely bilingual now. I'm not seeing any other questions coming through, Michelle. Maybe I could ask are we okay just for a few more minutes, or?
Yeah, no, we have a few more minutes, so feel free.
Well, how about, could I ask a question of the group just for the fun of it?
Yeah, let's go.
Well, I'm about to give up my British citizenship this year because I'm not sure but you can't be citizens of another country. So it's a big thing for us as a family. We're the first in our family to become American citizens. So just for the fun of it, what are some of the best things that England has ever contributed to mankind? I mean, I'll start you off with some low-hanging fruit, the Spice Girls. I mean, it's a classic. Soccer, tea. I mean, it's a big thing for us to give this up, so I'm just getting romantic now thinking about these memories. The Peaky Blinders. Anne, could I get a high five? It's a classic. Right from my own backyard as well. That's where I'm from, the centre of England. I'm from Stratford-upon-Avon, where Shakespeare's from, or Billy Shakes, as used to call him. Sounded rather rebellious at the time. Anne, what's OAR? O-A-R. Beatles. Princess Diana. Bless her. Scones. It's a classic. Bangers and mash. Just having some fun. Hey, we're going to have some fun, guys. It's Sunday. We're on a webinar, isn't it? We spend so much time at work. Martha's saying, how would you suggest talking to constituents who think that non-profit means that you should not talk about being a business or having a net income or profit? Great British TV, by the way. Yeah, did you catch that from Martha? Martin, the TV show. Did you catch that question there from Martha? That's a great question. I won't name them, but we work with about 4 or 5 very, very well-known non-profit entities. And that's one of the things that they struggle with. We also work with a lot of private educational entities. Again, I won't name them, but they're technically classed as a non-profit entity. And so sometimes managers can get, for want of a better expression, managers can get frustrated when the accountants, for example, start talking about, net profit or net income or expense management. And the way I would translate that to them is to emphasize that not profit doesn't mean you don't make a profit. It just means that because of your social purpose, you're not paying any tax. We've got to make sure that our income is bigger than our expenses, else guess what, sunshine? We may not be able to pay your paycheck. So be able to say to someone, we have to make sure our income is bigger than our expenses because, for example, payroll is one of our biggest expenses. And if we don't have enough profit to be able to cover our payroll, we're going to have a problem. We may have to borrow money. And the problem with borrowing money is the fact that we're going to have an interest expense attached to it, which just further reduces our expenses. So that's one of probably about 5 ways that I could think about that, Martha. I wanted to respect the time. Again, more than happy if anybody wants to email me. Lemon curd, that is a classic. That's a classic. Over to you, Michelle. London Calling from The Clash, that was a classic. Eric Cantona. People are much more interested in this, Michelle, than
We can keep going on all the great TV and musicians and food.
good stuff.
Does anybody have any more questions? I know hopefully a lot of you have ordered your Grubhub lunches. And if you want to stay on this chat or on our Zoom meeting here and have your lunch, feel free to do that. But if anybody doesn't have any other questions, Paul, we can let you go and enjoy your family on this Sunday.
Oh, thanks, Michelle. If I could just make just a very quick closing comment that, like I said right at the start, I'm conscious there's a whole range of levels of knowledge on the webinar, different roles, different responsibilities, different backgrounds. I endeavoured to do the best that I could to try and understand your world, specifically within your association, in addition to the clients that we serve in your field. I hope I've done an honourable job, Michelle, and I'm hoping if I could put you guys down as a reference for our citizenship, I'd really appreciate that.
Yeah, no, definitely. We really enjoyed it. And, you know, just so you know, a lot of the people on this Zoom are HR professionals. So I think this was really helpful for that group, not necessarily the CFOs or the business officers of our schools. So it's nice that they have an understanding of how the financial background works of all of our institutions.
Oh,
So,
Michelle, if I could make just one other very quick comment there, what we've noticed, you know, either as an employee for best part of 20 years and then doing what we've done for the last 14 now, is that really you can only make so much contribution based on your technical competence. For example, as a HR specialist, and if you're really good at managing yourself, you might be given that noble, honourable responsibility of influencing others, you know, leadership. But really you can make an incredible contribution if you've also got a sharp business acumen. You can move across industries, across organizations. But I've noticed that when HR people have a really good, sharp business acumen or business financial intelligence, they can make an even greater contribution to the organization. So I'm hoping in a small way we've kind of moved that needle a little bit. Thanks, Michelle.